Stop worshipping debt freedom. Most people spend their entire lives afraid of debt. They rush to pay it off. They avoid loans. They see borrowing as failure. Meanwhile, every wealthy person you have ever admired used debt deliberately, strategically, and repeatedly to build everything they own. Let that land. Debt is not the trap. Ignorance about debt is the trap. There is a brutal difference between the two. One form of debt silently drains your future. The other buys time, buys assets, buys leverage, and turns the banking system into a machine that works for you. This audiobook will permanently change how you see loans, leverage, and the bank itself. Not to make you reckless, to make you strategic. The way the wealthy have always been. Think about this for a moment. The bank lends you money at 5% interest. You invest that money in an asset that grows at 10% or more. The difference between those two numbers is profit, and it costs you nothing but the willingness to borrow. That is not recklessness. That is arithmetic. That is the same arithmetic the wealthy have been using for generations, while the middle class has been told to stay out of debt and live within your means. Living within your means keeps you safe, but safety has never built an empire. Leverage builds empires, and the bank is not your enemy. The bank is a tool. You just never learned how to hold it properly. Here is the uncomfortable truth that will separate you from everyone who listens to this and does nothing. Most people will hear this message and nod along, yet never act, because borrowing terrifies them. Not because they cannot afford it, but because they have never been taught to distinguish between debt that destroys and debt that builds. They lump all debt into one category, bad, and in doing so, they close the door to the single most powerful wealth-building tool in existence. You do not have to make that mistake. You are here because you are ready to see debt differently, not as a burden, as a bridge from where you are to where you want to be. And that bridge is already built. You just have to be brave enough to walk across it. Let's go deeper. Chapter 1. 2 types of debt. You were taught to fear the wrong thing. You were told debt is dangerous. Debt is stress. Debt is pressure. Debt is the reason people lose sleep, lose homes, lose control. And for most people, that is true. But it is only true because most people use debt in the weakest way possible. They borrow to look rich. They borrow to feel successful. They borrow to consume. Then they spend years serving the bill for something that got old, got smaller, or disappeared. That is not all debt. There is debt that makes you poorer. There is debt that makes you stronger. There is debt that buys applause. There is debt that buys assets. There is debt that feeds the ego. There is debt that feeds the machine. If you do not separate those two, you will spend your life fighting a weapon that could have been used in your favor. The first kind is ego debt. Ego debt is borrowed money used to finance an identity. It buys the car that makes you feel important. It buys the watch that gets noticed. It buys the vacation that looks expensive on a screen. It buys furniture for a lifestyle your income cannot support. Ego debt asks one question only: how will this make me look right now? That kind of debt is a thief. It steals future cash flow to impress people who do not care. It takes tomorrow's labor and spends it on today's emotion. It creates the illusion of elevation while quietly lowering your financial position month after month. The item loses value, the payment stays, the excitement fades, the obligation remains. This is where most people stop. They experience that pain and decide debt itself is the enemy. But the pain did not come from debt. It came from misusing debt. It came from using a financial tool for emotional relief. The truth is, money amplifies character. Debt does too. Now look at the second kind, acquisition debt. This is borrowed money used to buy or control something that produces value. It buys an asset that pays cash flow. It buys equipment that increases production. It buys inventory that turns into profit. It buys property that appreciates while rent helps cover the note. It buys time you would not have had if you waited until cash was perfect. Acquisition debt does not ask how this will make me look. It asks what this will produce. That is the dividing line. Ego debt consumes your life. Acquisition debt compounds it. The person trapped in ego debt becomes a servant to payments. The person skilled with acquisition debt builds systems that make the payments for them. Both borrowed. Only one built something that remains after the bill is paid. Same bank, same signatures, same monthly statements, different outcome, different psychology, different future. This is why wealthy people are rarely debt-free by accident. They do not wear debt as a badge. They do not chase debt for pride. They hold debt because it is attached to assets, and those assets are working harder than the interest they bear. They understand that eliminating all debt, without understanding what that debt controls, can actually make you poorer. If you use cash to pay off a low-cost loan secured by a productive asset, you may feel lighter, but you may also have killed your leverage, reduced your liquidity, and slowed your expansion. Most people chase emotional relief. Wealthy people chase strategic position. That does not mean every loan is wise. It means every loan must be judged by how it uses the money after it is received. Does it create more options or fewer? Does it generate cash or drain it? Does it strengthen your balance sheet or weaken your behavior? Does it make you more disciplined or more impulsive? Debt reveals your relationship with control. If you borrow for status, debt becomes a cage. If you borrow for production, debt can become a lever. A cage holds you in place. A lever multiplies force. Most people spend their lives inside the first, while complaining about the second. The truth is, the wealthy are not allergic to debt. They are allergic to dead debt. They are allergic to debt that does not earn. They are allergic to debt that depends on fragile income and emotional spending habits. They avoid useless liabilities, but they pursue productive liabilities because they understand a simple fact: most people never hear clearly enough. Not all debt asks you to pay. Some debt helps you get paid. That is why two people can both owe money and live in entirely different realities. One owes on consumption, the other owes on production. One has to wake up and work to keep the illusion alive. The other owns something that works while they sleep. One feels trapped, the other feels positioned. Outwardly, both are in debt. Inwardly and financially, they are not even playing the same game. This is where most people stop. They only ask whether debt exists. They never ask what the debt is attached to. That question changes everything. A payment on a declining toy is not the same as a payment on an appreciating asset. A loan for ego is not the same as a loan for acquisition. A balance that drains you is not the same as a balance that builds you. And because most people never learn that distinction, they spend years trying to become debt-free instead of becoming strategically financed. That sounds responsible. It sounds disciplined. But if your entire plan is just to eliminate every obligation, no matter what it controls, you may end up proud, safe, and financially small. The bank will no longer own a claim against your asset. Fine. But if you never learned how to use borrowed money to control more than your salary alone could ever reach, your financial life stays narrow. The world praises visible restraint, but wealth is often built through invisible structures, not loud purchases, quiet control, not appearance, position, not borrowed pleasure, borrowed power. The heavy truth is simple. Debt did not damage most people because debt is evil. Debt damaged them because they handed a sharp tool to an undisciplined mind. They borrowed to satisfy their identity rather than to acquire engines. They financed feelings. Then they called the consequence unfair. You cannot afford that confusion anymore. From this point on, every loan must pass a harder test. Does it feed your ego, or does it feed an asset? Does it make you feel bigger today, or does it make your financial system bigger tomorrow? If you cannot answer that instantly, you are still too close to the trap. And once you see that clearly, another truth starts pressing against the surface. If debt accumulates, the real question is not why the wealthy borrow. The real question is why they prefer borrowing even when they already have the cash. Chapter 2. How the wealthy actually borrow. Once you stop seeing debt as a moral issue, you can finally see it as a pricing decision. That is what wealthy people understand. They do not borrow because they are broke. They do not borrow out of desperation. They do not borrow because they need saving. They borrow because capital has a cost, and sometimes using the bank's money is cheaper than using their own. Most people miss that completely. They think borrowing means shortage. They think paying cash means strength. So when they finally have some money, they rush to spend their own first. They empty liquidity to avoid the discomfort of a payment. Then they wonder why opportunities keep passing them by. They made themselves less flexible in the name of feeling secure. The wealthy think in a colder way. They ask a better question. What is the cheapest source of capital available for this move? That question changes your entire financial behavior. If a bank offers money at a low fixed rate, and you can keep your own cash available for operations reserves or better returns elsewhere, why would you drain your own pile first? Why would you kill optionality just to say you paid cash? Pride says, pay cash. Strategy says, compare the cost. The truth is, wealthy people protect liquidity because liquidity is power. Cash in your control is speed. It is defense. It is opportunity. It is survival in downturns. It is the ability to move when others freeze. Once you understand that, you stop seeing cash as something to burn for applause. You start seeing it as strategic oxygen. A person with no debt and no liquidity can still be weak. A person with debt and strong liquidity can still be powerful. That is a hard truth for people raised on simple slogans. Other people's money is not a trick phrase. It is a principle of expansion. The wealthy use external capital to control larger assets, preserve their own reserves, and increase their rate of scale. They understand that every dollar of their own cash used in one place is a dollar that cannot be deployed somewhere else. So they become careful with where their personal capital gets trapped. This is where most people stop. They think the only cost is the interest rate. It is not. Using your own money also has a cost. That cost is the return that money could have earned elsewhere. That cost is the lost flexibility. That cost is the loss of opportunities you can no longer pursue because your cash is locked in something that could have been financed more intelligently. This is called the cost of capital, even if you never use the phrase. Every dollar has a job. If you use a dollar in one place, it cannot work in another. Wealthy people feel that trade-off sharply. Savers often do not. The saver says, I want peace, so I will avoid the loan. The investor says, I want efficiency, so I will price the capital. There is a massive psychological difference between those two people. The saver seeks relief. The investor seeks advantage. The saver wants to remove tension from the moment. The investor can tolerate tension if the numbers and structure serve the long-term position. That does not make the investor reckless. It makes the investor honest about what money is for. Money is not only for comfort, it is for control. When wealthy people borrow strategically, they are not celebrating debt. They are preserving capacity. They know that capital sitting with them can solve problems, secure deals, weather shocks, or seize discounted assets when markets get ugly. If all their cash is buried in purchases they could have financed cheaply, they become slower, more fragile, less dangerous. And the wealthy do not want to be less dangerous. They want to be in a position when everyone else is forced to retreat. This is why rich people often look paradoxical to ordinary observers. The observer asks, if they are so wealthy, why do they have loans? The answer is simple. Because the wealthy understand that being able to pay cash is not the same as being wise enough to use cash. They preserve their money when the spread makes sense, when the asset justifies it, and when the debt keeps them liquid enough to keep hunting. The truth is, wealthy people borrow from strength, not weakness. That is a line worth keeping. Borrowing from weakness feels like begging for oxygen. Borrowing from strength feels like renting force at a price below its utility. Same act, different posture, different result. You can see this in business. A disciplined operator may have enough cash to buy equipment outright, but chooses financing because that equipment will increase output immediately while leaving reserves intact for payroll, marketing, repairs, or the next expansion. You can see it in property. A strong buyer may avoid tying up every dollar in a single asset because financing allows them to control the asset while maintaining room to act. You can see it in investing. Strategic borrowers do not see every payment as pain. They see certain payments as the price of access. A price of access is very different from a penalty for being behind. One expands your options, the other closes them. Most people have only known the second. That is why they carry shame around borrowing. Shame blinds analysis. Shame makes people either avoid leverage entirely or use it carelessly in private. Neither path leads to precision. To use debt well, you have to strip the emotion away and study the economics. What does this capital cost? What does it allow? What does it protect? What does it free up? What return can it support? What risk does it add? Those are adult questions. Most people never ask them. They only ask, can I afford the payment? That is a survival question, not a strategic one. The wealthy ask, what does this financing do to my overall position? Does it increase control? Does it preserve liquidity? Does it improve return on my own capital? Does it place me in a better seat 5 years from now, 10 years from now? If the answer is yes, they borrow with composure. If the answer is no, they pass without emotion. This is where discipline becomes visible. Because wealthy borrowing is not impulsive, it is selective. Just because credit is available does not mean it is useful. Just because you can get approved does not mean the move is intelligent. Strategic borrowers are not impressed by access alone. They care about deployment. That is the deeper lesson. Borrowing is only step one. What matters is what the borrowed money touches. If you borrow cheaply and deploy badly, you still lose. If you borrow wisely and deploy to your strengths, the bank becomes an instrument for your expansion rather than a judge of your weaknesses. That is why the rich stay liquid and borrow strategically. Not because debt sounds sophisticated, because idle pride is expensive, because cash is precious when it remains under your command, because control matters more than appearances, because using only your own money can be slower, smaller, and far less efficient than using well-priced capital attached to productive assets. And once you begin to see borrowing through that lens, the next question becomes unavoidable. If capital has a price, then how do you know whether that price is worth paying? How do you measure whether the loan is actually serving you instead of slowly bleeding you? You measure the gap. You measure the distance between what the money costs and what the money earns. That distance decides whether leverage is feeding your future or eating it. Chapter 3. Understanding Spread. The Wealth Math. Emotion can start the decision. Math has to finish it. This is where excuses die. This is where fantasy gets exposed. This is where the language of wealth stops sounding mysterious and becomes mechanical. If you borrow money at one rate and deploy it into something that earns a higher rate, you have a spread. That spread is the heart of strategic leverage. If the spread is positive, The bank's money is helping build your position. If the spread is negative, the bank is feeding on your mistake. It really is that simple. Complex people often hide behind complex words, but the core idea is clean. Cost on one side, return on the other. The distance between them is either working for you or against you. The truth is, spread matters more than your feelings. If you borrow at 5% and the asset reliably produces 9%, the gap is 4% before other costs. That gap is not magic. It is not hype. It is the reason strategic borrowing exists. You are renting capital at one price and putting it to work at a higher price. That margin, if real and durable, is where wealth begins to compound beyond your salary. Because this is where most people stop. They hear that and get excited too early. They forget taxes, maintenance, vacancies, market risk, volatility, repair costs, timing, and error. They see the top-line return and ignore the drag underneath. That is not strategy. That is greed wearing a calculator. A real spread is not the dream number. It is the honest number. If an asset yields 10% on paper, but delivers only 6% after friction, and your loan costs 7% after fees, you do not have positive leverage. You have a polished mistake. This is why disciplined borrowers respect detail. They do not borrow based on hope. They borrow based on numbers that can survive contact with reality. Interest is not evil. It is a cost of doing business. That line matters because most people hear interest and think punishment. Strategic people hear interest and ask whether the cost is justified by the asset's output. Rent on a productive machine is not the same as bleeding for a bad decision. If the machine produces more than it costs to run, the machine stays. If it does not, it goes. Debt should be judged like an employee. If it produces more than it costs, keep it. If it drains more than it gives, fire it. That is the mindset. Spread also forces you to become more honest about returns. People love to overestimate what an asset will earn because it helps them justify the move they already want to make. They include best-case cash flow. They ignore mediocre years. They assume the market will cooperate. They round up on gains and round down on costs. Then they call themselves investors. No, they are just emotionally attached. A real operator does not need a flattering spreadsheet. A real operator needs a durable one. The numbers must still work when life stops being kind. That is why wealthy people spend so much time on underwriting. They pressure test the assumptions. They ask what happens if income drops, what happens if rates rise, what happens if expenses expand, what happens if the asset underperforms for longer than expected. They are not trying to kill the deal. They are trying to make sure the deal does not kill them. The truth is, a small positive spread held for a long time is more powerful than a flashy return built on weak assumptions. Stability matters. Durability matters. Repetition matters. The wealthy do not need every move to be spectacular. They need enough of their moves to work consistently for the machine to keep expanding. This is where leverage stops being a thrill and becomes an engineering problem. How much does capital cost? How much does this asset truly produce? How much buffer exists between those two? How fragile is the return? How fixed is the debt? How exposed are you if conditions turn? Those questions create calm. People who do not ask them borrow emotionally. People who do ask them borrow with control. There is also another layer. Spread is measured not only by yield. Sometimes it shows up as productivity gains, saved time, increased capacity, or greater operational reach. A business may finance equipment not because it yields an obvious percentage on a screen, but because it enables the business to produce more output, serve more clients, or lower unit costs. The spread still exists. It is simply expressed through stronger economics instead of a neat passive return line. That matters because not every productive debt looks like an investment account. Some of it looks like better systems, better tools, better access, better scale. Still, the rule remains. Borrow only when using capital yields a higher expected return than the cost of capital, and only when you have enough margin for error to survive reality. This is where most people stop. They want certainty. It does not exist. Spread is not a promise. It is an edge. Strategic borrowers are not chasing guaranteed outcomes. They are stacking probabilities in their favor. They are buying enough of an advantage that, over time, with discipline, the math keeps tilting toward them. That is how wealth is often built. Not through one dramatic act, but through repeated positive gaps. Small, efficient spreads, held long enough, protected carefully enough, expanded patiently enough. The outside world sees the result and calls it luck. But luck rarely survives that much math. The truth is, most poor financial decisions are not caused by lack of effort. They are caused by lack of spread. People borrow for things that produce nothing, or they borrow at costs too high for the asset to support, or they misread the return, or they leave no buffer. Then when pressure comes, the whole structure shakes. Spread is the signal. If the gap is weak, do not force the move. If the gap is strong, respect it and structure around it. This one discipline alone can separate productive debt from financial self-sabotage. It can protect you from deals that feel exciting but quietly rot. It can keep you patient while others rush into pretty traps. And then another force enters the picture, a force that punishes savers, changes the real cost of debt over time, and quietly rewards borrowers who locked in the right structure while holding assets that rise with the currency itself loses strength. That force is already in your life, whether you understand it or not. Chapter 4. Inflation. Your silent ally. You can work hard for money and still lose to the currency holding it. That is the part most people never understand until it is too late. They think saving cash alone is safety. They think a growing bank balance means progress. They think if they avoid debt and stack money, they are being disciplined. But if the purchasing power of that cash keeps shrinking, while the cost of everything real keeps rising, then what looks safe can quietly become a source of erosion. Inflation is subtle violence. It does not knock on your door. It does not shout. It simply makes your saved dollars buy less over time, while assets, services, and necessities drift upward. People feel it at the grocery store. They feel it in housing. They feel it in insurance. They feel it everywhere. Yet many still think in raw numbers rather than real purchasing power. That mistake is expensive. If you hold cash during inflation, the number may remain the same, but the power inside that number decays. You did not lose visibly. You lost silently. That is often worse because you never built the habit of defending yourself. Now look at fixed debt. If you borrowed at a fixed rate and used the proceeds to control an asset that rises with inflation or to generate income that can rise with inflation, something important happens. The dollars you repay in the future are worth less than the dollars you borrowed today, while the asset may be worth more, and the income attached to it may have grown. Pause. Same payment, weaker dollars, same debt, stronger asset. That is not an accident. That is structure. This is where most people stop. They only see the debt's existence. They do not see the changing value of the currency used to repay it. If you owe a fixed amount over time, while inflation keeps reducing the real burden of those future payments, debt can become lighter in real terms. Not always, not automatically, but often enough that strategic borrowers pay close attention to it. The truth is, inflation punishes idle cash and can reward productive fixed debt. That does not mean debt is always good in inflation. Variable rates can hurt. Weak assets can fail. Poor cash flow can collapse. But if you lock in manageable financing on a productive, or appreciating asset, inflation can work beside you instead of against you. Think clearly here. If wages rise slowly, rents, prices, and asset values rise, while debt service stays fixed, the spread between what the asset produces and what the debt costs may improve over time. The asset continues to adjust to the new price environment. The debt does not. That fixed liability becomes easier to carry if your income and the asset's output grow with inflation. That is why some people fear inflation and others quietly prepare for it. The wealthy do not only ask how much something costs today, they ask how the debt behaves in real terms over years. They ask whether the asset can reprice upward. They ask whether income from that asset can rise while the debt remains fixed. They ask whether they are positioned on the side of hard assets or on the side of shrinking currency. That is a very different conversation from basic budgeting. Reset. Inflation is not just a headline, it is a transfer. It moves power away from passive cash and towards scarce assets, pricing power, and structured borrowers. Scarce property can benefit. Productive businesses with pricing power can benefit. Certain commodities and equity claims can benefit. Not because they are magic, but because they are tied to real economic activity, limited supply, or rising replacement costs. When currency weakens, reality gets repriced. And if your debt is fixed while your reality gets repriced upward, the burden of yesterday's borrowing may become easier to manage tomorrow. This is why simply hoarding cash can become a hidden loss. People say, "At least I am safe." But safe from what? If the money buys less every year and you avoided productive assets because debt made you uncomfortable, then your caution may have cost you more than a well-structured loan ever would have. The truth is, the world does not reward emotional safety forever. It rewards intelligent positioning. That does not mean emptying reserves. It means knowing the role of reserves. Cash is still necessary. Cash is defense. Cash is optionality. But cash is not a final destination. Holding some cash for control is wisdom. Hiding in cash because you do not understand assets, leverage, or inflation is surrender. This is where most people stop. They react to inflation after it has already reshaped the field. They complain about prices. They blame the economy. They tighten up emotionally. But they never ask the harder question. How do I position myself so that inflation helps me rather than humiliates me? That answer begins with structure. Fixed debt when the terms are right. Assets that can appreciate or reprice. Cash flow sources that can rise with the environment. Reserves that protect your patience. And the discipline to borrow only when the asset is stronger than the fear. Because inflation exposes financial passivity. It reveals who only saves and who actually positions. It reveals who understands that the number in the account is not the same as the real power behind it. It reveals who has something that rises with the tide and who is standing still while the water climbs around their ankles. Do not misunderstand the lesson. Inflation is not your friend because it exists. It becomes an ally only when your structure is right. A person with floating debt, weak income, and no reserves can still get crushed. A person with fixed costs, durable assets, and patience can be carried forward by the same environment. Same inflation, different preparation, different outcome. That is the pattern again. The tool is not the problem. Structure is the answer. The bank, the asset, the debt, the environment, the cash flow, all of it matters. And once you understand that, another truth becomes obvious. If capital can help you, and inflation can, then access to great capital matters more than most people realize. Not all borrowers are treated equally. Some ask for money, others attract it. And once you understand how banks determine the difference, you stop thinking like an applicant and start positioning yourself as an asset they want on their books. Chapter 5. Becoming the borrower banks compete for. The bank is not judging your worth. The bank is pricing your risk. That distinction matters because emotion ruins leverage before leverage even begins. Most people walk into lending as if they were asking for personal approval. They feel small, defensive, hopeful. They think the credit score is the whole story. They think a yes means they are responsible and a no means they are weak. The lender is asking colder questions. How likely are you to repay? How stable is your income? How much margin do you have? How disciplined is your history? What assets back you? What cash reserves protect you? How predictable are your behaviors? How profitable are you as a borrower? Once you see that clearly, your whole posture changes. Creditworthiness is not a badge. It is a strategic asset. It lowers your cost of capital. It expands your options. It gives you negotiating power. It lets you move faster when opportunity appears. A weak borrower asks if they can get approved. A strong borrower asks who wants the paper and on what terms. This is where most people stop. They obsess over the score and ignore the profile. Yes, the score matters. It is a shortcut signal, but it is not the only one. Banks look deeper. Debt to income matters. Liquidity matters. Length and quality of repayment history matter. Asset base matters. Business cash flow matters. Tax returns matter. Stability matters. Clean records matter. The story your numbers tell matters. The truth is, lenders love predictability. If your life looks erratic, your access will be expensive or limited. If your finances look disciplined, your access expands. Not because they admire you, because you fit their model of low-friction profit. So become that profile on purpose. Pay on time without fail. Protect your reserves. Avoid chaotic borrowing. Keep utilization controlled. Do not apply to every shiny offer recklessly. Build documented income. Keep clean records. Reduce obvious instability. If you run a business, tighten your books. If you earn personally, make your income legible. Banks do not reward mystery. They reward evidence. A disciplined file is a silent weapon. Clean numbers negotiate before you speak. Order creates leverage. There is also a difference between being approved and being competed for. Approval means someone will lend to you. Competition means multiple lenders want your business enough to sharpen terms, lower rates, expand limits, or move faster. That difference can save you enormous amounts over years. It can also make deals possible that would otherwise stall. How do you create that position? By becoming less desperate, by needing the money less visibly, by holding reserves, by demonstrating options, by borrowing from strength, not panic. Desperation makes you expensive. Stability makes you attractive. The truth is, banks respect control. A borrower who can clearly show cash flow, reserves, low chaos, and a purposeful reason for capital looks very different from a borrower chasing relief. One appears as an operator, the other appears as a rescue case. Banks do not compete to rescue, they compete to fund stable profit. You do not ask to be seen as strong. You build the evidence so strength is obvious. Then the conversation changes by itself. This also means your relationship with banks should be proactive, not reactive. Do not wait until you are cornered to clean up your profile. Do not wait until you urgently need capital to discover that your records are a mess, your income is unclear, or your obligations look bloated. Strategic borrowers prepare before the request exists. They structure first. They seek capital second. That timing changes everything. Because when you approach from a position of preparation, you can negotiate, you can compare terms, you can walk away, you can choose lenders who understand your model, you can refuse bad structures. The person who arrives late and desperate does not negotiate. That person accepts. This is where most people stop. They only think about the bank when they need something. But the bank is watching a pattern, not a moment. Your financial profile is a long conversation. Every late payment, Every maxed line, every unexplained swing, every sloppy report, every empty reserve, every emotional borrowing decision, it all speaks, so make it speak well. If you want the bank to compete for you, become less emotional with money, reduce personal chaos, build professional habits, know your numbers, understand your ratios, keep your word. Lenders love repayment history because repayment history reveals character under pressure. You do not need to be flashy, you need to be reliable. Reliable gets funded. And once reliability becomes visible, leverage becomes a negotiating position instead of a desperate request. Now you can ask sharper questions. Can the rate improve? Can fees be reduced? Can terms extend? Can collateral requirements soften? Can limits rise? Can the structure better match the asset? This is no longer begging. This is pricing. That is a different identity. The truth is, capital is easier to access when you appear least emotional about it. That is not because banks are cruel. It is because systems reward stability. If your profile says discipline, reserves, clarity, and performance, lenders assume lower friction and lower default risk. That lowers the price. Better terms create better spread. Better spread improves outcomes. Better outcomes strengthen your profile further. The cycle compounds. And that compounding matters because what you do with capital after you get it is where the real game begins. Cheap money alone does nothing. Approval alone changes nothing. Terms alone are not wealth. They only become wealth when deployed into things that keep growing, keep paying, and keep compounding long after the thrill of access is gone. That is where borrowed money stops being permission and starts becoming fuel. Chapter 6. Deploying debt into compounding machines. A loan by itself is not a strategy. It is stored potential. What matters is where that potential goes after it hits your hands. This is the place where disciplined people separate from excited people. Excited people celebrate access. Disciplined people study deployment. They know a cheap loan can still become an expensive mistake if the money enters weak assets, unstable ventures, or shallow vanity moves. The point is not to borrow. The point is to borrow into compounding. Compounding machines are assets or systems that can grow in value, generate income, reinvest their output, and continue to do so over long periods. Some businesses do this. Some real estate does this. Some diversified equity holdings do this. Productive systems do this when cash flow is managed well and time is given room to work. Time is the multiplier people underestimate most. Most people want leverage to create immediate escape. That impatience ruins them. Strategic borrowers do not need the debt to produce fireworks next month. They need the debt attached to something durable enough that, over the years, the combined force of cash flow, appreciation, reinvestment, and a reduced real debt burden creates a widening gap in their favor. This is where most people stop. They can handle the idea of making money. They cannot handle the boredom of letting money machines mature. They want quick proof, quick status, quick release. That is why they keep sabotaging compounding. They interrupt the process to chase stimulation. Compounding hates interruption. A rental property that slowly improves income and value over years can become far more powerful than a flashy speculation that burns attention and capital. A business system that reliably converts borrowed capital into repeatable demand can outclass a dozen emotional moves. A portfolio fed consistently and held through time can do work that raw effort alone cannot match. The truth is, the machine matters more than the mood. When borrowed money enters a compounding asset, leverage amplifies the result. If the asset rises, your equity can grow faster than if you had waited to buy only with cash. If the asset throws off cash, that cash can help service the debt while also building additional reserves or funding further acquisitions. If the debt is structured well and given time to work, the system can gradually become more self-sustaining. Pause. This is how people stop renting out their labor alone. This is how capital starts taking shifts for you. This is how the machine begins to remember your discipline. But only if the asset truly compounds. That is the standard. Not every purchase is an asset. Not every asset compounds. Not every compounding story is durable. Some things only look productive because markets are temporarily generous. Some businesses depend too much on a single client, a single trend, or a single operator. Some properties do not cash flow. Some investments are too volatile to carry leverage safely. Strategic borrowers must separate real compounding from seductive noise. That requires patience and selection. Compounding also changes how you think about time itself. Salary grows linearly for most people. Systems can grow exponentially when output is reinvested, when appreciation adds to equity, when debt remains fixed, and when skill improves deployment over repeated cycles. The first few years can look slow. Then the curve bends. Then the machine starts doing what human effort alone never could. This is where most people stop. They quit before the bend. They panic during the quiet years. They misread slow growth as failed growth. That is a psychological weakness disguised as practicality. The truth is, patience is one of the most important tools of leverage in existence. Without patience, debt becomes pressure. With patience, well-structured debt can become acceleration. You need enough reserves and emotional control to let the asset season, let the tenants stabilize, let the business refine, let the market cycles pass, let reinvestment do its quiet work. Short attention destroys long money. That line deserves to stay with you, because every compounding machine asks the same thing. Can you avoid touching the roots while you are hungry for fruit? Can you resist the urge to interrupt the process just because progress is not loud enough yet? Can you hold structure long enough for structure to reveal its real power? Reset. Most wealth is not built in moments of excitement. It is built in long seasons of correct repetition. The borrower who understands that becomes hard to beat. There is another layer here. Borrowed money into compounding systems does more than increase financial output. It trains identity. It forces you to think in terms of systems rather than paychecks. It makes you ask what produces, what scales, what repeats, what survives your absence. Those are not consumer questions. Those are ownership questions. Once your mind starts asking ownership questions, salary loses some of its emotional grip. You still respect income. You still need cash flow. But you stop treating work alone as the whole plan. You start building structures that retain, multiply, and outlive effort. That is the real point of strategic debt. Not having more stuff, having more systems. And systems demand that you think beyond this month. They demand buffers. They demand good underwriting. They demand responsible leverage. They demand enough humility to know that compounding is powerful, but not instant. When people fail here, it is usually because they confused leverage with speed. Leverage is not speed by itself. It is force. If you attach force to a durable machine, time rewards you. If you attach force to chaos, chaos expands. The truth is, compounding does not care about your intentions. It cares about your structure. It pays whoever respects its rules. So choose the machine carefully, borrow carefully, size the risk carefully, preserve patience aggressively, reinvest when appropriate, track performance honestly, let boring assets do glorious work over long periods, let the bank's money participate in the build, but never let your emotions drive the steering wheel. Because once leverage enters the picture, the numbers are no longer the only challenge. The greater threat often comes from your own mind under pressure. The machine can be sound, the spread can be healthy, the structure can be right. And still, If your psychology breaks during volatility, you can destroy what the math was trying to build for you. That is where the real war begins. Chapter 7. The Psychological War of Leverage. Leverage does not create pressure. It reveals whether you can carry it. That is the truth most people never want to hear. They blame the debt. They blame the market. They blame timing. But often the structure was not what failed first. Their mind did. Their emotions did. Their need for certainty did. Their inability to sit still under temporary discomfort did. Leverage amplifies outcomes in both directions. That is its nature. If the asset rises, gains grow faster. If the asset falls, pain arrives harder. If cash flow tightens, every payment feels louder. If markets swing, your thoughts swing with them, unless discipline is stronger than fear. This is where most people stop, not at the numbers, at the feeling. They cannot stand the sensation of owing while prices move. They cannot handle the headline, the temporary drop, the tenant issue, the business slowdown, the sudden doubt. They start making emotional decisions inside structures that were built for long-term logic. Then they call leverage dangerous, when the deeper problem was unmanaged psychology. The truth is, many people fail with leverage psychologically, not mathematically. That line matters because it changes what you train. If the real danger were only the calculator, then once you knew the spread and the debt service, the problem would be solved. But that is not enough. You also need emotional range. You need patience under ambiguity. You need the ability to distinguish volatility from destruction. You need to avoid turning temporary discomfort into permanent damage, because debt talks to your nervous system. A monthly obligation is never just a number. It is a pressure signal. It asks whether your reserves are real. It asks whether your confidence came from analysis or from hope. It asks whether you built room for error or only a flattering scenario. It asks whether you can remain rational while carrying responsibility that does not disappear because your mood changed. Leverage is a test of structure. Then it becomes a test of self. Most people prepare for the first and ignore the second. That is why downturns expose so much. A leveraged position can be perfectly sound over the full arc and still feel unbearable in the middle. Prices may drop, income may tighten, news may darken, other people may panic. The environment may challenge your conviction every day for a season. If your decisions were built on shallow confidence, that season will break you. Discipline is what carries logic through emotional weather. Without discipline, leverage turns into emotional torture. With discipline, leverage becomes manageable weight, not light, not casual, manageable. That distinction matters. Strategic borrowers are not relaxed because risk vanished. They are composed because they prepared for pressure, sized the exposure, kept reserves, and built a framework that tells them what matters and what does not. They borrow right at the edge of their emotional tolerance. Then when ordinary volatility arrives, it feels like catastrophe. Their position may still be salvageable, their math may still be intact, but their mind cannot hold the tension, so they sell low, panic payoff, stop reinvesting, or abandon the system at the exact moment when patience is most valuable. The truth is, if leverage steals your sleep, you are likely carrying too much or carrying it for the wrong reason. That is not weakness, it is feedback. Leverage should demand respect, not worship. You do not need maximum debt. You need sustainable debt. You need structures your cash flow can carry, reserves that can protect, and a psychology that can survive. That means stress testing more than the balance sheet. Stress test yourself. How do you behave when uncertainty rises? Do you obsess over daily movement? Do you catastrophize? Do you seek relief too fast? Do you need everything to feel safe all the time? If so, lower leverage may actually produce better long-term results, because you can hold it without being sabotaged. The goal is not to borrow as much as possible. The goal is to borrow as much as you can govern. Control is the whole game. Mental discipline with leverage comes from a few brutal habits. Do not count on perfect conditions. Keep reserves that buy you time. Know your breakpoints before they arrive. Separate market noise from cash flow reality. Review the thesis, not just the emotion. Avoid status-based borrowing entirely, because ego debt becomes psychologically unbearable much faster. And never confuse motion with action. Sometimes the strongest move under pressure is to do nothing reckless. That is hard for anxious people. That is why anxious people should not wield large leverage. And there is no shame in that. The shame is pretending to maturity you have not yet built. The shame is taking on obligations bigger than your discipline. The shame is using force you cannot govern, then blaming the force. The truth is, leverage is honest. It exposes impatience. It exposes fragility. It exposes false confidence. But it also rewards calm, reserves, preparation, and long-horizon thinking. It can turn ordinary people into operators if they treat it with respect. It can also turn impulsive people into cautionary stories if they treat it like a shortcut. So do not romanticize it. Leverage is not glamour. It is pressure attached to possibility. If you can carry the pressure, you may get the possibility. If you cannot, the same tool can punish you. That is why emotional control is not a soft skill in wealth building. It is infrastructure. It is as important as the rate, the terms, the asset, and the spread. A weak mind inside a strong structure can still lose. A strong mind within a good enough structure often finds a way to endure, adapt, and emerge larger on the other side. And once you understand that, you stop asking only how to use debt. You start asking when to keep it, when to reduce it, and when eliminating it becomes the highest return move available. Because strategic borrowing is not blind loyalty to leverage, it is disciplined control over when leverage serves and when it no longer does. Chapter 8. When to hold debt and when to kill it. Wisdom is not in holding debt forever. Wisdom is in knowing what the debt is still doing for you. That question should follow every liability you carry, not once, repeatedly. Because a loan that served you well at one stage can become mediocre later. A rate that once looked cheap can become heavy if cash flow changes. An asset that once justified leverage can weaken. A personal balance sheet can evolve. Opportunity cost can shift. Your job is not to worship leverage. Your job is to audit it. This is where mature borrowers separate from debt addicts. Debt addicts only want access. Debt critics only want relief. Strategic borrowers want truth. They ask, does this obligation still create more value than it costs? Does it protect the liquidity I still need? Does it support an asset or system that continues to justify its existence? Or has the debt outlived its usefulness? The truth is, some debt deserves to be held. Some debt deserves to be buried. Low fixed debt attached to productive or appreciating assets can still be worth keeping, especially when the asset's output, inflation dynamics, or opportunity cost of cash all support that decision. But high-interest debt draining real returns, unstable debt pressuring the system, or debt attached to weak assets often becomes dead weight. Dead weight is not strategy. Dead weight is ego-wearing analysis. You need a framework. Start with cost. What is the real rate after fees and structure? Then look at output. What is the debt attached to? What is that thing earning, saving, or enabling? Then look at alternatives. If you paid this debt off today, what else could that cash have done? Then look at risk. Does holding the debt create vulnerability that no longer matches the reward? Then look at your psychology. Is the debt manageable pressure or corrosive pressure? Every debt position should earn its place. If it cannot defend itself under scrutiny, It should not stay in your life. Sentiment has no authority here. This is where most people stop. They use one rule for everything. Always pay off debt fast, or always keep cheap debt forever. Both are lazy. Reality is more precise than that. The right move depends on the debt, the asset, the environment, and your broader system. Blanket rules feel safe because they remove the need to think. Strategic control demands thinking. Sometimes paying off debt becomes the highest return available. If the interest rate is crushing, the asset is weak, the cash flow is unreliable, or market conditions no longer support the original thesis, killing the debt can be the cleanest path to strengthening your foundation. Reducing guaranteed drag can beat chasing uncertain upside elsewhere. Freedom is not always emotional. Sometimes it is mathematical. Other times, paying off debt too early is a mistake. You may destroy liquidity. You may trap cash in a low-yielding decision. You may lose the chance to deploy that capital into better opportunities. You may pay off a manageable, inflation-softened fixed liability while leaving yourself smaller and slower. So ask better questions. If I keep this debt, what advantage remains? If I kill this debt, what risk disappears? If I keep the cash instead, what options stay alive? If I pay it off, what opportunities die? If rates, income, or asset performance change, what happens next? What is my exit plan if the original reason for holding the debt weakens? That last question matters more than people think. The exit strategy should be in place before the loan is taken. Not because you plan to fail, because adults plan for conditions changing. When will you refinance? Under what conditions will you sell? At what point will you accelerate principal reduction? What signals indicate that the debt no longer deserves a place on your balance sheet? Debt should never be a permanent emotional attachment. It is a tool with a job. When the job is done, the relationship can end. This mindset protects you from two common forms of self-deception. The first is fear-based paydown. That is when you rush to eliminate productive debt, simply because owing makes you uncomfortable. The second is ego-based holding. That is when you cling to leverage because it makes you feel sophisticated, even though the numbers no longer support it. Both are traps. One is driven by fear, the other by vanity. Neither is guided by truth. The truth is, strategic people reevaluate without sentiment. They are willing to hold debt that serves. They are willing to kill debt that drains. They do not need to be ideologically pure. They need to be positionally strong. That is a powerful difference. It means you stop making debt decisions based on what sounds responsible in public. You start making them based on what actually improves your total financial structure. You stop performing discipline. You start practicing it. Real discipline is not in suffering through bad obligations to prove toughness. Real discipline is in cutting what no longer works and keeping what still compounds. This is where most people stop. They want a slogan. Life gives them context. They want certainty. Finance gives them trade-offs. They want one permanent answer. Strategic debt requires ongoing judgment. That is why it remains a game of thinking, not obedience. And the more precisely you think, the clearer the bigger purpose becomes. The purpose was never debt for its own sake. It was never approval. It was never a higher limit, just to feel bigger. The real purpose is building systems strong enough that your life no longer depends entirely on selling hours for income. That is the horizon every smart liability should point toward. Not more payments, more independence. Chapter 9. From Income to Systems. You were never meant to stop at earning. Earning matters, income matters, skill matters. But if all your money depends on your constant presence, then your life remains manually powered. You can make more, you can work harder, you can negotiate better. But as long as the engine is your direct effort alone, you are exposed, tired, limited by time, limited by attention. limited by the number of hours your body and mind can keep selling. Strategic debt exists to help break that ceiling, not by replacing work with fantasy, by using capital to build systems that can produce beyond your personal labor, systems that collect rent, systems that process demand, systems that own output, systems that hold appreciating assets, systems that generate cash flow without demanding your full attention every minute. This is where most people stop. They use debt to raise their standard of living instead of improving their structure. They finance comfort, they finance convenience, they finance appearances. Then they complain that debt made them feel trapped. Of course it did. They turned a tool for building systems into a tool for decorating a cage. The truth is, strategic borrowing should move you from income to infrastructure. That means every major liability should be judged by one brutal standard. Does this help build an engine that can earn with less dependence on my daily labor? If the answer is no, caution should rise immediately. If the answer is yes, attention sharpens. Now you may be feeding something that scales. A debt-funded asset that produces cash flow can start small. It does not need to replace your full income on day one. That is impatience talking again. The point is to build one engine, then another, then strengthen the system that holds them. Over time, the cash flow from those assets can begin to cover expenses, fund reserves, finance future acquisitions, or reduce the emotional pressure on your earned income. Pause. This is how labor stops carrying the full burden. This is how money begins learning your name. This is how systems slowly take over the heavy lifting. Think about what financial sovereignty actually means. It does not mean zero effort. It means your life is not cornered by a single income source, employer, client, or paycheck. It means you own structures that produce. It means your survival is less dependent on being personally perfect every day. It means you have time, room, and negotiating power because assets are doing part of the work. That is freedom in practical form, and debt, used correctly, can help accelerate the building of those systems. It can help you acquire assets earlier than your cash alone would allow. It can let you preserve reserves while still establishing productive holdings. It can move you into ownership faster if the structure is sound and the asset is real, but only if the goal stays clear. The goal is not to look successful. The goal is to reduce dependence. The goal is not to upgrade appearances. The goal is to own a cash-flowing structure. The goal is not more complexity for its own sake. The goal is systems that keep earning when your effort pauses. This is where most people stop. They make more money and spend more money, but they do not build more systems, so their lifestyle expands while their dependence remains. In some cases, it gets worse. They need more income to meet additional obligations without an increase in true ownership. Their life looks larger from the outside, but remains financially manual underneath. That is a dangerous illusion. The truth is, wealth is not the same as high income. Wealth is durable systems, controlled obligations, and assets that keep working. High income with no systems is just a well-paid treadmill. Strategic debt matters because it can help you step off that treadmill and start laying track in another direction. Every productive asset is a soldier you no longer have to be. Every cash-flowing system takes a shift you used to work yourself. That is the quiet beauty of ownership. Once systems begin to form, your behavior changes. You think longer term. You value liquidity differently. You start measuring decisions by system impact, not just monthly comfort. You become more patient because you are feeding structures that take time to mature. You become more selective because not every opportunity strengthens the system. Some only distract from it. That is maturity. And this is why the wealthy so often sound detached from salary conversations. It is not because income means nothing. It is because they understand that earned income is only one stream, and often not the one that creates lasting scale. Systems create scale. Systems persist. Systems can be sold, refinanced, expanded, delegated, or inherited. Systems outlive moods. Debt used to build such systems can therefore become part of a very serious life design. Not a trick, not a hack, a design. You borrow to acquire force. You deploy force into assets. Assets produce cash flow, appreciation, or both. Output strengthens reserves and equity. Stronger reserves and equity improve future access to capital. Capital funds more systems. The loop expands. That is how lives change without noise. The truth is, the final aim is not to earn more forever. It is to own enough productive structure that your choices expand, your dependence shrinks, and your time is no longer sold from a position of weakness. Strategic borrowing is simply one of the tools that can help you reach that condition faster if you use it with restraint, math, and discipline. And once you see the end state clearly, one final shift must occur. You can know the mechanics, you can know the numbers, you can know the systems, but if your identity still belongs to the fearful borrower, the impulsive spender, or the approval-seeking consumer, you will eventually drift back into old habits. So the last move is not financial, it is personal. You must become the kind of person who handles debt as a tool and never again as a mirror. Chapter 10. The Strategic Borrower's Identity. A strategy can be forgotten. An identity gets carried into every room. That is why this cannot remain a collection of tips in your mind. It cannot stay as something you understood once while listening. It has to become a permanent operating principle. The moment you face your next loan, your next opportunity, your next urge to consume, your next temptation to impress, your next desire for relief, your identity will decide faster than your intellect. So decide who you are. The strategic borrower is not seduced by access. The strategic borrower is not frightened by debt itself. The strategic borrower is not impressed by status purchases. The strategic borrower does not ask whether borrowing feels good. The strategic borrower asks what the capital will control, what the structure will produce, what risk is being carried, and whether the debt strengthens or weakens future freedom. That is a different kind of person. This is where most people stop. They learn a framework, but they never change the self that uses it. So under pressure, they regress. They borrow for ego when tired. They pay off good debt from fear when stressed. They chase bad opportunities when bored. They confuse access with intelligence. They keep the old identity and expect new outcomes. The truth is, financial control is a character issue before it is a money issue. Character here does not mean morality theater. It means your actual habits under pressure. It means what you do when no one is watching. It means whether you seek status or strength. It means whether you can delay applause for position. It means whether you can look ordinary while your structure grows in silence. Silence is part of this identity. The strongest financial moves are often invisible. No one applauds the clean balance sheet, the fixed low rate on a productive asset, the preserved reserves, the patient hold, the repeated reinvestment, the refusal to finance a false image. But those quiet choices forever separate the strategic borrower from the average consumer. The crowd pays to be seen. The strategic borrower pays to control. That difference echoes for decades. A strategic borrower also knows that every debt decision is made inside a framework, not a mood. What is the cost? What is the expected return? What does this control? What happens if conditions worsen? What reserves exist? How does this affect liquidity? Is this ego debt or acquisition debt? Does this move build a system or decorate a weakness? Those questions become automatic. They protect you from yourself. That is the real value of identity. It removes negotiation with temptation. When your identity is clear, you do not debate every obvious trap. You simply do not step into it. You do not borrow to perform a life you have not built. You do not carry liabilities that drain your future for a few weeks of stimulation. You do not confuse the bank's willingness to lend with proof that the loan is wise. This is where most people stop. They want tactics without standards. Standards are what save you. Standards are what tell you no when desire is loud. Standards are what tell you wait when the spread is thin. Standards are what tell you hold when the structure remains sound. Standards are what tell you exit when the debt no longer earns its place. The truth is, the powerful use debt with emotional detachment and strategic clarity. They do not idolize it. They do not fear it. They govern it. That word matters, govern, because debt is force. Force without governance becomes damage. Force under control becomes leverage. And there is something else. This knowledge is not only for you, it is legacy. Most people inherit confusion around money. They inherit fear of debt or addiction to it. They inherit silence, shame, and shallow rules. If you understand the difference between ego debt and acquisition debt, between pressure and productive leverage, between consumption and control, you can pass down something more valuable than opinions. You can pass down operating principles. That matters, because every generation that learns to use capital with discipline starts life from a different place, less reactive, less trapped, more precise, more capable of turning institutions, assets and time into allies instead of enemies. That is not only wealth building, that is sovereignty. Debt is not the master. Debt is not the mirror. Debt is the tool, and you are the one holding it. Hold that line carefully, because if you forget it, debt can become your excuse, your fear, your ego, or your cage. If you remember, debt can become rented force within a disciplined system. It can help you buy time, buy assets, preserve cash, widen spread, survive inflation more intelligently, attract better terms, build compounding machines, and move from labor into ownership. That is the complete shift. Not everyone should borrow aggressively. Not every asset deserves leverage. Not every opportunity is real. But every future debt decision you make can now pass through a harder, cleaner, stronger filter. Does it build? Does it produce? Does it preserve control? Does it reduce dependence over time? Does it fit the structure of the person you are becoming? If not, walk away. If yes, move with discipline. The truth is, the wealthy were never playing a game you were excluded from by fate. They were often just seeing tools through a different lens. They learned that debt in ignorant hands is ruin, but debt in disciplined hands can become architecture. They learned that banks are not gods, they are sources of capital. They learned that loans can buy slavery or sovereignty, depending on what the money touches after it arrives. So let this be settled now. You will not fear debt blindly. You will not chase debt blindly. You will study it. You will price it. You will structure it. You will govern it. And from this point forward, every obligation either serves your empire or gets no place inside it. Debt reveals what you worship. If you worship appearance, debt will expose you. If you worship control, debt can serve you. The bank does not decide your future. Your structure does. Cheap money in a weak mind is still expensive. A loan attached to ego becomes a sentence. A loan attached to production becomes force. Most people borrow to feel rich. The disciplined borrow to build. Liquidity is not comfort alone. It is command. Interest is not always punishment. Sometimes it is rent on acceleration. Spread is the quiet judge behind every debt decision. Inflation punishes the passive and rewards the positioned. The crowd saves numbers. The strategic saves purchasing power. Access to capital means little without control over self. Leverage amplifies character before it amplifies wealth. Reserves buy patience. Patience protects structure. Not every debt should live. Not every debt should die. The question is always the same. What is this debt doing for you now? Salary can support life. Systems can outgrow it. The goal was never more payments. The goal was more independence. Wealth is rarely loud while it is being built. Silence, discipline, and clear numbers defeat most financial noise. Debt is not the trap. Ignorance is. The tool was never the danger. The hand holding it was.